Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the Federal Reserve's interest rate decision report and the potential trading opportunities that will come about of the event, mostly on the US dollar and gold. My name is Sasha and I'm a financial analyst from the research department at ForTrade. If you have any questions, please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that all gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, first off, we'd like to introduce you to what we call a market opportunity. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade on the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions and based on historical evidence. This can relate to daily trading, weekly trading, or monthly trading. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's solely your decision whether you trade on market opportunities or not. Here's an example of a market opportunity. You can see some fundamental analysis on what's going on with the euro-dollar currency pair. You can see that this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-US dollar currency pair. For example, the part on the situation in Italy, which has affected the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the left-hand side of the screen here, this shows the right moment in our estimation for opening a trading position. That's how you decided to trade on this opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further down. At these points you can put a stop loss and take profit, and on the right hand side of the screen you have calculations. If you close the position using take profit, you can expect these kinds of profits at these support levels in green. If the price is going against you, you can potentially have a loss of this amount at the resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. So what's the Fed and the FOMC? Well, as we know, the Federal Reserve is the central banking system of the United States that implements monetary policy. The current chair of the FOMC and the Fed is Jerome Powell, a Trump appointee, but he has faced unprecedented criticism from the president, who has clearly expressed his dissatisfaction as interest rates have not come down as quickly as President Trump would like. The FOMC is crucial since it's the body that makes important decisions on monetary policy by raising or lowering its target for the federal funds rate. That has a great impact on the price of the dollar. The Federal Reserve's mandate is a dual one. One is to keep inflation below or close to 2%, and the other is to create jobs. And it does this with monetary policy, that's by setting interest rates. You can see on this table how the Fed has kept interest rates historically low as monetary medicine to kickstart the economy following the financial crisis. As the US and global economies strengthened in recent years, you can see how rates increased to 2.5%. But following the recent global slowdown and the ongoing trade war, rates were cut in July last month to 2%. The previous Federal Open Market Committee meeting took place on September the 18th. The interest rate was cut by 0.25%, in line with analysts' expectations. The decision to cut interest rates was split, with members divided on what action the central bank should take moving forward. 5 members wanted the Fed to hold its previous range of 2% to 2.25%. 5 others supported Wednesday's cut, but wanted to keep it at that level through the rest of the year. while 7 members wanted at least one more reduction in 2019. Monetary Policy Committee member James Bullard wanted to lower rates by even more, half a percentage point. The fact that market bulls have an obvious ally in the dovish Bullard led to expectations that there is more scope for future rate cuts. On the other hand, the central bank's official forecast foresaw no immediate cuts in rates this year and early next year. Upon the announcement of the expected decision last month, the euro-dollar traded 0.31% lower, without major movement by the end of the trading week, remaining at the same level. Investors were expecting the cut, but overall, despite the Fed's forecast, investors continue to believe that the most likely next move would be that the Fed would cut another 0.25% in October, putting some pressure on the dollar. We can see how the dollar index, which measures the currency against a basket of other currencies, was impacted. Upon the announcement, the dollar dropped and the currency moved slightly higher by 0.18%. Since then, Governor Powell has stated that although the economy faces risks, the Fed is ready to act. So what can we expect at this meeting? The US Central Bank is expected to cut interest rates from 2% to 1.75% when it meets on October the 30th. As you can see, there is a 92.5% probability, according to CME Group, that rates will be cut by 0.25%. On the other hand, as I mentioned before, the central bank's official forecast foresees no immediate cuts in rates this year and early next year. But the markets are not expecting interest rates to remain at 2%, and they have correctly predicted previous cuts. But if they are wrong this time, we could expect to see the dollar jump sharply higher and potentially for stock prices to fall. This month's Fed interest rate decision comes as the dollar has fallen sharply to 2-month lows. Economic data in the US has shown that the economy is weakening, and fears have risen that the trade war and economic slowdown is finally biting the US as much as the rest of the world. For this reason, there is increasing pressure both on the US administration to reach a trade deal with China, or at least to stop its escalation, and for the Fed to cut rates to keep the US economy strong. A softer dollar has already priced in a rate cut this month, so traders will be looking for a neutral to dovish Fed to state that it is prepared to cut rates further if necessary. Stocks remain close to record highs, and lower rates would provide a boost. But the markets will likely move most on what Chair Powell has to say in the press conference after the Fed interest rate decision. As always, bear in mind that any decision to trade dollar currency pairs, gold or stocks should be made with the geopolitical situation in mind, including the trade war, as well as on the direction of interest rates and NFP figures. And speaking of the NFP, on Friday the latest figures will be announced. While the decision won't impact this month's Fed decision, since it's after the Fed meeting on Wednesday, it's worth looking at expectations since it will likely have some influence on the next Fed meeting. It's expected that October's figures will show that 105,000 new jobs were created last month. Unemployment is expected to move from last month's 3.5% to 3.6% in October. Average hourly earnings are expected to be 3%. As always with the NFP, a better or higher than expected number of new jobs tends to push the value of the dollar up, while a lower number is seen as bearish for the dollar, tending to push it down. The idea is that a worse than expected figure would suggest that the US economy is slowing down, thus increasing the chances that the Fed will continue to cut rates. Well, I hope you found this webinar useful. Of course, at ForTrade we will be following developments related to both the Fed decision and the NFP for what will be a very busy week's trading. Please get in touch with your senior account manager for further information. Until next time, goodbye, and please join us at ForTrade again soon.